Good afternoon, everyone. Thank you for joining me for the quarterly taxation update from Vincent's. We'll just wait a couple of seconds just for everyone to log on. Okay, we've got a few people in there now, so we might get started. As I mentioned, thank you for joining me for the quarterly taxation update for the June quarter. Now, my name's Ollie Visser. I'll be your presenter today. Just a bit of information about me. I'm a manager in business advisory here at Vincent's. I've also popped up my contact details there for you. So if you do have any questions today, please feel free to contact me directly, and I'll get back to you with answers as soon as possible. So I'll just read our disclaimer as well. So the information contained in this presentation is intended for general use and guidance only. None of the information presented should be considered as formal advice, and any imputation in that regard is specifically rejected. So that being said, if there are topics today that do come up that you would like some advice about, or you have further questions about, as mentioned, please feel free to contact me. All right, so there's been a few key changes over the last quarter or so. So we've broken them down into four key aspects, and the ones that I'll be touching on today will be key changes for individual taxpayers, key changes for small business. We'll take a look at the corporate tax rate, and being tax time, we'll also touch on some tax time reminders. Now, some of these have been laws since 1 July 2017, whereas others have only just started 1 July 2018. So the first topic we'll look at today is the key changes for individual taxpayers. Now, this is one of the ones that came through in budget night. So the government's got a plan over the next coming years to provide tax relief for individuals, and it's been proposed that they will do that in a three-step process. So the first one will be low and middle income tax offset, which will run from the 2019 financial year, or now from 1 July 2018 through to the 2022 financial year. And the second part of their plan is to provide relief against bracket creep. Now, I'll go into more detail about each of these segments in the next few slides, but basically the relief against bracket creep will also take place from the 2019 financial year through to the 2022 financial year. So the initial part of that plan will provide relief of up to $135 to affected taxpayers. And then we look at the second part of the bracket creep relief, which will be from the 2022 financial year to the 2024 financial year. And again, affected taxpayers for that one will be provided with relief of up to $1,350. Now, the last part of the plan from the government, and step 3, is to actually remove the 37% tax bracket completely. Now, obviously, the big benefactors there will be the middle income earners. And it's also worth noting that from 1 July 2017, the temporary budget repair levy has also actually been removed, which was an extra 2% tax for high income earners. So let's take a quick look at the first part of the plan from the government. So the first part is the low and middle income offset. The government's estimated that this offset will benefit about 10 million low and middle income earners. So the benefit starts immediately for taxpayers that earn up to $37,000, or the low income earners, and they can get a maximum tax relief of up to $200. The benefit then increases into the next bracket of income above $37,000 up to $47,999, and gradually that $200 relief increases to $530. Now, to get the full benefit of the $530, you need to be inside the $48,000 to $90,000 tax bracket. But that's not to say that over $90,000 you don't get any benefit. The benefit just reduces above $90,000 until it reduces down to $1 for taxpayers earning $125,000, 333. Now, the second part of the government's plan is the relief against bracket creep. So I guess that begs the question, what is bracket creep? So bracket creep is basically where income increases with inflation rates, but the tax brackets stay the same. eventually pushing certain taxpayers into the higher tax bracket, which means they'll obviously have to pay a bit more tax. So the government's looking to combat this as soon as 1 July 2018, because in the 2019 financial year, they have increased the 32.5% tax bracket to 90,000 from 87,000. Now, the affected taxpayers in that particular bracket can receive relief of up to $135 per year. Now, as mentioned in the earlier slide, this is part of a two-phase plan to relief against bracket creep. Now, the second part of the plan takes place from 1 July 2022, and it targets the low-income earners, but also the middle-income earners. So the first part of that will provide tax relief up to $540 by increasing the 19% tax bracket from where it's currently at $37,000 to $41,000. And they will also be increasing the low income offset from $445 to $645. Now, as well as the 19% tax bracket, the 32.5% tax bracket will also change again from 1 July 2022. And that is changing the 32.5% tax bracket limit from $90,000 to $120,000. Now, this can provide tax relief of up to $1,350 per year for affected taxpayers. Now, the third part of the plan and the final part of the plan is the government suggested that they will abolish the 37% tax bracket. Now, that will take place in the 2025 financial year. At this stage, the government has estimated that approximately 94% of all individual taxpayers will actually then fall into the 32.5% tax bracket. So as you can see on the right there, we've got the table which outlines the tax rates for the 2018 financial year and how that's going to change leading into the 2025 financial year. So the obvious ones, the tax-free threshold will stay the same at $18,200. As mentioned before, the 19% tax bracket upper margin will increase from $37,000 to $41,000. And the big changer is the 32.5% tax bracket, which the top margin will increase from $87,000 to $200,000, which then sees the 37% tax bracket become obsolete in 2025. Now, there's also a change to the 45% tax bracket, because as the 32.5% one is increased in 2025, 45% will now apply to income earners above $200,000 instead of above $180,000. If you'd like some more information in regards to the changing of the individual tax rates and the tax relief provided by the government, you can actually have a look at the link that's there, which is the budget website. They go quite into detail about why the plan was formed and the more finer intricacies of the plan itself. All right, so we'll touch base on our second topic, which is key changes for small business. Again, there were a few coming out of the last quarter, but the main one, again, comes out of budget night. And as many can probably already guess, that one is the extension of the $20,000 instant asset write-off. Now, it had been rumoured that this would stay around for the next 12 months. However, it wasn't until budget night that it was actually confirmed that it would be extended for another 12 months from 1 July 2018. Now, basically what the instant asset write-off is, it applies to the business use portion of assets that are under $20,000. So you'd be able to get an instant deduction for those assets rather than having to depreciate them over several years. Now, to gain access to these concessions, you need to be a small business entity. Basically, the turnover rule needs to be passed, and you have to be able to, and you are carrying on a business. So the turnover rule requires that you earn 10 million or under, and carrying on a business is a bit more tricky. There's quite a few boxes there to check, which we'll actually touch on in the next few slides as well, as quite a few of our subjects today do go back to that concept of carrying on a business. If you would like to see the eligibility for small business entity concessions, you can visit that link just below there for some more information, or alternatively, of course, you can contact us. All right, we'll take a look at our third topic for the webinar, which is the corporate tax rate. So there's been talk about the corporate tax rate changing over the last little while, and the government's put in a plan over the coming years to ultimately reduce the tax rate down to 25% for certain entities. Now, basically, to be able to get the lower tax rate, as it currently stands, you need to be what's defined as a base rate entity, which basically we'll get into that on the next slide. But as you can tell from the table, you need to meet a aggregate turnover test. So if your turnover for the relevant year is below those listed in the table, you will be eligible for the lower tax rate if you are also a base rate entity. So all other companies will still be paying the 30% tax rate. So are you eligible for lower tax rate? So this is where the definition of the base rate entity comes in. So basically a base rate entity has aggregate turnover of less than the relevant threshold, which in the 2018 financial year was 25 million. So if you earned under 25 million, and from 1 July 2018, that's been increased to 50 million. So that's the first part of a base rate entity. The second part, again, as we touched on in a previous slide, is that you need to be carrying on a business. Now, as I mentioned before, there's quite a few boxes to check with this one. The ATO have advised that we can look at taxation ruling 2017/D7 for extra guidance on this. Despite that actually being a draft ruling at current stage, it can still be relied upon, is what the advice was from the ATO. So touching on that one as well, I guess the other question is, so what is aggregate turnover actually? So aggregate turnover is your annual turnover for the income year, the annual turnover of any entity connected with you for part of the income year or the whole income year, and the turnover of an entity that is an affiliate of yours for part of the income year or the whole income year. So it's not as simple as just looking at your entity itself, or maybe your trading entity, and saying, okay, well, whatever the turnover in that one is, that is your aggregate turnover. It can be quite complex if you do have several entities. So again, we would encourage you to contact us at Vincent's for more guidance around this if you did have some questions. Now, hand in hand with the lower tax rate, we also come to the question of what is the franking rate. So the franking rate essentially is the rate at which you can frank your dividends when you pay them out of your company. Now, we've been advised by the ATO that your franking rate will be based on your prior year turnover. So what that means, as an example, if you wanted to work out what your franking rate for the 2018 financial year would be, you would have to look at your company's turnover for the 2017 financial year. And if that is less than 25 million, then you will be franking your dividends at 27.5% rather than 30%. Now, this topic as well, it is quite a complex one. So if you do want to find out some more information, there is a link there that you can look at. Now, it's also worth noting there has been a proposed change to the definition of the base rate entity. So as I just touched on, the current definition is that is under the relevant threshold for aggregate turnover, and that you are carrying on a business. Now, the proposed change suggests that the carrying on a business test will be replaced with an 80% passive income test. So basically what the passive income test is, if the corporate entity, if 80% or more of the corporate entity's income is from passive assets, so it might be investments, then you will not be eligible for the lower tax rate, regardless of what the turnover is. It's worth noting that this bill has actually been knocked back from Parliament at current and is currently unenacted. However, this could still be relevant in the next few months when Parliament sit again. All right, so our fourth and final topic will be some tax time reminders. So some of the things mentioned in the tax time reminders will be things that have been in law since 1 July 2017, but obviously being tax time, it's worth keeping these in mind, whereas other things that we'll touch on have been enacted from 1 July 2018. All right, so some of the ones we'll touch on is the First Home Super Saver Scheme. That one's been around since 1 July 2017. We'll also touch on some changes to rental property deductions. These are particularly relevant to taxpayers that might have investment properties. Again, that one's been around since 1 July 2017, but it's worth considering now, being 2018 tax time. We'll also touch base on the GST on residential rental property sales and the GST on low value imported goods, which both have started since 1 July 2018. All right, so the first one we'll touch on, as mentioned, is the First Home Super Saver Scheme. Now, as I mentioned, this one's been around since 1 July 2017. Basically, it's a scheme that's been brought in by the government to reduce the pressure on housing affordability. Now, how this works is all contributions, voluntary contributions, voluntary concessional and non-concessional contributions are eligible from 1 July 2017. So those contributions sit in the First Home Super Saver Scheme, where it will provide a rate of return which is equal to a rate of return earned by a 90-day bank bill plus 3%. Obviously, it's quite relevant for people that are looking to buy their first home, and it's an alternative to having money sitting in a savings account or something else. So how this works, as mentioned, you can do voluntary concessional and non-concessional contributions. Voluntary being things like salary sacrifice, and non-concessional meaning after tax, so just after tax contributions prior to 30 June. How the scheme works, 15,000 maximum contribution per year can count towards the scheme. So you might make more contributions than that per year. However, only 15,000 will actually relate to the scheme in a particular year. Now, there are some other eligibility rules to consider as well. Similar to the First Home Buyers Grant, you can't have owned property before. You have to be 18 years of age or older. You intend to live in the property as soon as practical, and you intend to live in the property for at least 6 of the first 12 months that you own it. Now, why this is relevant now at 1 July 2018 is you can actually start to withdraw the amounts from your First Home Super Saver Scheme from 1 July 2018. Now, the maximum that you can withdraw overall under the scheme would be 30,000 plus all the associated earnings. So if we take a look, there's only 15,000 you can do per year. So if you started in 1 July 2017, at 1 July 2018, technically all you could pull out would be your 15,000 plus the associated earnings. Now, it's also worth noting, when you actually do go to apply to draw this money out, you need to make the application to the ATO. The ATO will issue you with a payment summary, and they will actually withhold tax on your behalf, which will be equal to your marginal tax rate less a 30% tax offset. Now, there's some other key points to note as well about the First Home Super Saver Scheme. The first one is that non-concessional contributions are tax deductible from 1 July 2017. So again, this one's been around for a year now, but basically what that means is you can still get a tax benefit from doing after-tax contributions if you haven't salary sacrificed anything during the year. Now, basically this has come about because the 10% test has been abolished, and basically what that 10% test was is if 10% or more of your income in any given year was, more than 10% was for salary and wages, it meant that you're ineligible to claim non-concessional contributions as a tax deduction. Whereas now that that's gone, obviously that's different, especially big change for employees that do earn salary and wage. The other thing to note is both you and your spouse can use the scheme. So this is where it's a little bit different from the First Home Buyers Grant, because if your spouse has used the First Home Buyers Grant in the past, then you automatically won't be able to use that as well. Whereas under the super one, you can both actually put yours to the same property if you'd like, or you can buy separate properties or use them at different properties down the line. Now, again, there's a bit more guidance in regards to the First Home Super Saver Scheme if you do want to have a look, and following that link is probably a good first start. But again, if you do have any specific questions, feel free to contact us. Okay, so the next one that we'll touch on, and again, these are the ones that have been around since 1 July 2017, some key changes to residential rental properties and the deductions. Now, again, as mentioned, this is going to be quite relevant to taxpayers that do have investment properties. So the first one there is travel expenses. Now, basically, ATO came out and said from 1 July, travel expenses to rental properties for things like inspecting the property or collecting rent will no longer be tax deductible, where it has been in the past, unless you do that in the form of carrying on a business. So there's our carrying on a business concept again, or you're an excluded class of entity. Now, an excluded class of entity is a corporate tax entity, a public unit trust, a managed investment unit trust, or a partnership or unit trust that includes some of those entities. Again, if you want to read a bit more about that, I'll put the link in there. Now, the next one also related to residential rental properties. The other deduction targeted by the ATO is the deduction for depreciable assets on second-hand plant and equipment. So again, this will no longer be deductible to any properties purchased after 9 May 2017. So how it worked in the past for investors is you would be able to go and buy your investment property. Often a quantity surveyor would be engaged to prepare a depreciation report, which would take into account all second-hand assets already on the premises and also the structure of the building itself. So second-hand plant and equipment being things like an oven or a dishwasher. Basically, what the ATO is saying now that those things will no longer be deductible. But that's not to mean that you can't go out and buy new assets. So if you went out and bought a brand new stove for your property that was purchased after 9 May 2017, you will still be able to get a depreciation deduction for that. It's just the existing stuff bought with the new property. Now, that's not to say that a quantity surveyor's report becomes obsolete, because as I mentioned before, you can still get a capital works deduction for the structure of the property itself. If you have any questions in relation to any of these items specifically, again, please contact your Vincent's professional. All right, so looking at some changes now that have started from 1 July 2018, the first being GST withholding on residential property sales. Now, my colleague Ben Hitchings actually touched on this one last quarter and mentioned that we do expect it to become law from 1 July 2018. So I can now confirm that has become law from 1 July 2018. And I've just provided a little summary here that we can run through just how the whole process works. So firstly, we'll look at which properties are affected by this new law. And basically, it's the taxable suppliers of new residential premises or potential residential land. So potential residential land might mean zoned for residential. However, there's nothing on there currently. And this is quite key for property developers to keep in mind as well. So which contracts would be affected? The obvious one is contracts entered into after 1 July 2018, as that's when this particular law will apply from. However, contracts entered into before 1 July 2018 can also be affected if they settle after 1 July 2020. So how does the whole process work? Well, the purchaser will be withholding the GST and will pay that directly to the ATO instead of the supplier. So the main rate that will be withheld on is 10% of the contract price. However, if the GST margin scheme has been engaged for the contract, it would actually be 7% of the contract price that will be withheld. Now, the final change to GST and our final topic today will be the change to low-value imported goods. So in the past, low-value imported goods being under $1,000, there was no GST effect there. From 1 July 2018, that has now been changed. So even low-value goods will have GST on them. So businesses that are registered for GST and turning over 75,000 a year will need to consider how this changes their operations. And again, I've put in a link there just for some more information that you can also look at. Now, just in conclusion, so we've touched today on a few topics. So as mentioned, some of those have come out of budget night, the main ones being the individual tax rate changes and also the small business instant write-off being extended. Now, we've also looked at the corporate tax rate and how that's going to change gradually over the next years and what that means for the 2019 financial year. And we've also looked at some tax time reminders, being the first home super saver, the rental property deductions that are no longer allowed, and also the changes to GST from 1 July 2018 for sales of residential rental properties, and also for the low-value goods, low-value imported goods. If any of those topics, if you had any further questions, please feel free to contact us. As I mentioned, my details are on the second slide. I will look, and I would endeavour to get back to you as soon as possible. And that will conclude our presentation for today. Thank you for joining me, and I hope you have a good afternoon.